I think last time we were doing ratios. We did even a question from one of the past papers, and I shared with you the Excel on that issue. So I want to proceed. I think with still on performance evaluation. As said, performance always is tested more often. As you may check, you notice most of the performance, most questions are, every exam, there is always a performance issue there. So we need to move on and they try to do, even the unit we are doing is called strategic performance, meaning performance is actually quite a case that is also tested routinely. So we have to move to performance. We did last time ratios on which are also performance measures on company level. Now we need to go to other performance measures also on divisional level and all the rest. And we need to move on and see. So I have, I think on the screen, you could see the slide. So probably, and then we have questions. We'll carry them to the Excel and do them. We have questions, of course, in the past papers. We need to go through them and see. But in the meantime, let's give a background of what we need to do and what is the concept, the formula. Most of the performances is about the formula. I think unless it is a non-financial, but most of the performance are about triggering the getting the formula and applying it, if especially those which are financial financial concepts which require calculations. So if that is the case, I think we can move on. Now I shared with you the Excel. Of course, the somebody was asking if it balanced. It balanced because of course there was an issue which was to do with the taxes, which I had not factored in. At that time, it wasn't ringing in my head. I think for that time, we were in that moment. But later on, I checked the tax changed because the tax was not an issue, but the tax was computed on 30% basis. So it computed itself on 30%. And, anything that affect the balance sheet should always either the balance sheet is always either an accrued issue or it is something which is not paid. So, of course, the changes in tax, that difference created something that was unpaid for unless we reduced it in the cash. So that's why it kind of balanced. And then there was another issue was the stocks. The stocks opening stocks changed. And then when you fix that, your balance sheet should be able to agree with what we did last time. You check, I did the workings. So the tax issue is what I fixed. And I also fixed the stocks. Opening stocks affected the retained earnings because in the process of valuation, they changed the stock valuation and it affected the previous stocking. If you check, you notice that was what I did. I think it's still here. So somebody was asking if the balance sheet balance, it balance. I think in the moment I was most having pressure of trying to complete what it is. But if you check, I shared with you this, the balance sheet kind of balanced and it balanced with, I introduced this, there's a tax payable because of the changes in tax. Remember, the tax was computed on 30% basis. It is not a fixed tax, or it multiplies this by 30 if you check that. So at that moment, it wasn't ringing the bell that the tax had changed, but after some time, I realized the tax had changed. So the tax had changed. If you compare the previous one, you notice it's not the same. This was the previous tax that was recorded. The previous tax that was recorded was this one. This one. Those were the previous taxes which had been recorded. Of course, which are not the same with this. Because after we did the changes, these taxes are not similar. You could check and you may notice that are not the same. So it meant there is something which changed, and the change is either in the balance sheet, is either was it paid or it was not paid. If it's not paid, if it was paid, then we reduce from bank, and we don't post it as a payable. But since it was it was not paid, as it was not mentioned anywhere, so it became a liability, and that's why I adjusted here. So this is the difference between those. If you check, is the difference between those, because if you check, it is this one here, and if you subtract these, you will get that is where the difference is. Just to explain what could have cost, I think I should have maybe put some minus on something, but it's the difference that came between those taxes, which is this tax here that was there. I think it seems to be positive, so I should just plus it. And then when you get that, that was a difference, which is what I posted here. But it increased. So here it reduced because it was 1.5. It increased. It increased, as you may notice. So that is what the changes were. As you may notice, this went up and also that really shot up. So there are differences which came from that. Also, this was similarly, here it was higher, while here you could notice there was that. So those are the changes which are adjusted, and the balance sheet kind of course, balanced because there was a changes which took place. Now, this, of course, increased, so it became payable. And the other one reduced, so it became recoverable. I think those who know reporting, most of you, of course, are reporting also students, one way or another, with the intermediate. So the changes were these ones here. They were the ones which were causing the balance sheet not to balance. Apart from that, the taxes, the inventory. You see, the inventory also was valued differently. Opening inventory under FIFO was this. In LIFO, it was that. When you check, there was a difference of this 39, and that, of course, kind of also created that difference that we had. And the difference appeared to the cost of sales. So it is also what I fixed here. If you check, you notice is what I fixed also here. And when it's fixed, then your balance sheet balances. But anyway, that is something for another day. I'm here to move on ahead. I think you'll check that I shared with you. What I need to do, unless anybody has a question in the Excel which I shared, if there isn't, then we move ahead and I progress with the other performance measures like return on investments. There is a residual income that we need to go through as we move ahead. So if there's no question, we can move to this. So I've made a slide. I think the slide is on your screen there. You could see the slide. So there is a learning objectives. We have to explain the use and the limitation of return on investment. Excuse me, also referred to as return on capital employed in terms of what it is. So we have to move to that. So we are moving there. We have questions we need to do. The more we try to use our time efficiently, the more we could do better. So then there is another explanation is the use and the limitation of residual income for evaluating investments. So another issue after that will go to EVA. So in short, we are simply going through other additionals, which are called also divisional performances. And we have to know the divisional performances are also something we'll have to go through. Divisional performances is also quite is a performance issue that we go through. And we're going through the return on investment. Apart from return on investments, we're going to go through the, residual income, and then we go through what we call EVA in short. So those are also other performance measures that are supposed to be covered as per this. Now, that is it. And we need to try to move ahead and see how to deal with that. So if you check, I need to explain the use and the limitations, and those are the things as for investment centers. And I think if you check, you notice that an investment center is where you have invested, so you need to evaluate it and know how it is performing. That is what we need to do. So we'll get to know that and move on. So let me move to the next issue. So the next issue is, I moved here. So part 2 will be the objectives to explain some of the issues apart from return on investments, residual income, EVA. We'll also go through the transfer pricing. Later on, we'll do transfer pricing. Hopefully, if not today, we'll go through transfer pricing in the next class, which is, of course, to talk about transfer pricing issues and all those cases. And then, of course, before transfer pricing, after transfer pricing, we'll talk about non-financial issues, which are also there. Or we'll talk about non-financial in summary because it's more theoretical, and then we move ahead to that. So apart from that, we need to discuss the international issues that arise on transfer pricing. So investment centers, many firms use profit centers to evaluate managers, but firms cannot use profit alone to compare the business unit to other businesses unit because of different in sizes and different in operating characteristics. So the sizes also create that. To evaluate financial performance of investment centers, we need to somehow incorporate the level of investment capital in the performance measures. So we have what is called SBU, which is a strategic business units, which are the one we measure. The intention of measuring is to try to motivate the managers to exact high level of effort to achieve certain goals. Of course, to provide the right incentives, because things like return on investment is to say we have invested this, what are we getting in form of returns? So they give us that. So there is need for this, and there is a provide right incentive for the managers to make decisions that are consistent with the goals of the top management and goal congruency. Goal congruency is I will share with you. I think I have maybe some other notes which I'll share with you on some summaries of the notes. But goal congruency basically means where all the companies working hand in hand, not conflicting. So fairly determining the rewards earned by the managers for their effort and skills, return on investment, as we may go through that based on comparisons between, of course, different centers that you're operating from that case. So anyway, the other methods we used, which are divisional performances for investment center, we use what is called return on investments, residual income, and economic value added. So we're going to go through this, pick a formula, check out the formula, interpret the formula, use it, and that's it. Like I said, basically here, the words which are connected to this have a meaning to it. Like return on investments, it means what you're getting from what you've invested, and what you invested come from, total assets you have done, or from the finance side, which is capital employed. And then the residual income is what is the balance after all possible deductions that have been taken in consideration. Economic value added, what have I added as from previous is an incremental analysis. What have I added since last year or since the last period from the using of my resources? So they have a meaning to what they do. Now, number one, let's go to let's start with the return on investment. Return on investment is a relative measure. A relative measure means it is measured per certain issue. So, or it is measured according to certain issue. Absolute means it is just a difference between that. It is not measured according to what you put in. So I always say return on investment is measuring what I put in versus what I'm getting. Then there is that what we need to find out. That's why it's called a relative measure. ROI, as is famously known, or sometimes ROCE, is the most common measure. Question. What? Okay. Are we on the same slide? I hope so. Somebody was asking a question or something? Okay, if there's no question, I was thinking maybe you're talking to me. Let me just try to, move on. So there is ROI, which is return on investment. Some I will refer to as ROCE, which is the return on capital employed. Because generally capital employed, it's as I said, when somebody is saying return on capital employed and another one is saying return on investment, they're talking about the same thing. Why? Well, because one is referring to where the money went, which is return on investments. Investments, as I said, strategically, if you look at how business is run, you have capital, you have liability, which are your finances. You pump them into assets, and the assets are called investments. You invest them, and that is an investment, and that's what is called return on investments. Alternatively, you could view it from the source of money, which is return on from the capital employed, which is from the finance side. So one is viewing from the finance, another one is viewing from the asset side or investment side. But all in all is the same, because the capital employed is pumped in or is realized through investments. So the formula is here. Profit, as I say, this is an area where it is a matter of profit, is a matter of formulas, and you adapt the formula and you move on. With some other areas, non-financials, which are more like theoretical to explain. So return on investment is profit divided by investments, and return on investment could be also return on sales multiplied by assets turnover. And then return on investment could also be profit, a relationship of profit out of sales, and then divide by also sales, multiply by sales in relation to the asset, which they cancel, and then it become back to this. So that is what return on investment is about. So in practice, we'll be aware of different ways of defining profit. Like I've always said, some people ask, oh, profit is called names, but based on where it is coming from and or based on where it is going from or where it is going to. So you have to know. Sometimes you calculate return on investments based on return on, we calculate based on profit before taxes, or we calculate also on profit after tax. It depends on what you are given. Again, it depends on what you are given. If there is any profit which seems to be a profit that is reported at that particular moment, you use it as it is. Investment for that purpose is, of course, determining what it is. Investments mostly is assets. If they give you total assets, because that's where the money goes in, and that is how it is from that case. Unless there's anybody with a question, what we need now is to apply the formula and see how it is. That is a return on investment. Sorry, I think I've moved quickly. Return on investments, those are the formulas. So if you don't have, actually they are part of what develops what is called return on investments, which I said is also referred to as return on capital employed. So as you may check the formula, the two components of return on investments give a more complete picture of performances, and the goal should be set for each of the two components. One is return on sales or a profit margin, a firm profit per sales dollar. I was using dollars as a standard measure. Measures the manager's ability to control expenses and the increase in revenue to improve profitability. Assets turnover, the amount of dollars sales achieved per dollar of investments, measures the manager's ability to increase sales from a given sort of investment. As I said, it's a relative measure because you divide by investment. So they're trying to interpret, what does it measure? What am I getting for each dollar that I pump in? That is a return on investment, or for each amount that I pump in. So basically, this one has an example here. I don't need to go into that. I want to set I want to use the OpenTuition to use that for that case. This was what I was doing somewhere else. But because I'm using OpenTuition, let me use OpenTuition to deal that and maybe be concerned with that issue. The formula is already there. I've explained what it does measure. And this is just an example we're using somewhere else from that cases. But let's use OpenTuition because we've been using that to do some demonstration. I want to pick a question from there and then we move ahead and see, because the next is to do an example to see how this can be practiced from that angle. Unless there is anybody with a question before we go to residual income. No question. Okay, if there's no question, there is a past paper question we'll focus on probably from that angle, then you could come up with the questions of your own. Now, there is also from summary, which is offered by OpenTuition, which I like to use for quick summaries or quick movements, because it has some quick examples here. We have, again, just to make a cross-reference, you may check here, there is they have told you about the division of performances and orders, investment centers. This is more like theoretical issues, but return on investment is defined as controllable division performances as a percentage of investments for that case. It is equivalent to return on capital employed, which I was talking about here, and is one of the reasons that it is very popular in practice as a division of performances. So there is an example here. We can use this example to apply the formula, and then we see how it would be. From there, we'll easily know how it can be done before we check our past paper and do some question on that area. Let's try them. First of all, clean an example which is more focused on that area. We can take it to the Excel here and use it from that case. We can use that in the Excel, apply the formula. As I said, when it comes to performances issues or performance evaluation, just make sure you at least know the formulas, because most of the time is about the technique of the formula and how you apply it in that context. You could be able to interpret a variety of issues that relate to that. Unfortunately, I think the fortunate part, I think you do the open book, so you can always cross-check. But you may need to remember the formula. Some of the formulas are very easy. Like this one here, it is not a big formula. It is just a short formula you have to remember. So here is the Excel. I think if you are seeing the Excel here, pasted here. So my intention is to try to solve this first here as a company as a whole. That is what I'll try to test this before we tackle any past paper question. We could tackle this. Then B. B is I need to, of course, tackle this one here, and I see how it could be. So in the meantime, let me start with A. Kenya Public Limited, Kenya Public Limited Company has a division throughout ballistic states. The Ventpils division is currently making profit of 82,000 per annum in dollars on investment of 500,000. Akania has a target return of 15%. Full stop. The manager of Ventspil is considering the new investment, which will require an additional investment of 100,000 and will generate an additional profit of $17,000 per annum. Calculate whether or not the new investment is attractive to the company as a whole. So first of all, before you benchmark this against the new investment, or before you decide on the investment, you need to benchmark these against the current performances. So there is a target. The target is to have 15%. That is what they have targeted. And this, we need to calculate that and see. So let's check the current status so that we can know how it will perform. The current status, are they achieving the target first? That will be the first question. Is the company achieving the target? Is the company achieving the target? Is the company achieving the target? If not, we'll have to, of course, first of all, check into that and see why. So the current status is that the company, we may calculate what is called the return on investment. Now, return on investment, as you may notice, if you check, we have said, if you calculate return on investment, as you may notice, we have said you will take the profit probably that is given. So you may take profit and you take the profit you have, and that profit you have to divide with, of course, investments. So that's what we do. We'll take the profit. I can call profit pi. So we'll take pi, which is a profit, and then we divide by investments. Anyway, just let's come here. So we'll have this that is not really coming out clearly. Return on investment, you have to take profit, and then you divide by investments. Investment has been given through where the money has been pumped in, which is through assets. So if you check, let's gather the information. Do we have the profit? Do we have the profit currently? Just give me a minute. I admit some people. Do we have the profit? Yes, we do have the profit. I want to pick each element if I have it, and then I use it by after I get the division sign, I apply that. So there is a profit. The profit is said to be, as you may notice, I've said it is 82,000. From there. Then there is, do we have investment? Yes, we do have investments. Investments is equals to 500,000. So that is the investment. We have the profit, and that is what we have from that basis. So that's the case. Now, after that, we need to, of course, take this here, which is the profit, and divide by that, and you have these. And when you convert this into percentage-wise, you get that is equals to 16. So they are, of course, achieving above the target, which is a good indicator. So they are achieving above the target, as you may notice there. They are above the target. The target is supposed to be 15%. So the company is performing fairly good, no problem. But then there is an option of thinking about this. There is an option of thinking about the other option, which is in this case, they want to add 100,000. So if they add 100,000, this is the proposed. The proposed. So the proposed. Sorry, the proposed. So the proposed is that they want to propose to have 100, and the 100 is projected to increase or to add on $17,000. So if I pick the figures out, let me pick the figures out so that I can pick my formula. I can attach them to the formula. The profit for the new proposed is supposed to be 17,000, and the new investment, the investment section of it is that it is 100. It's $100,000. So that is the case there. So if you check that, that will give you that. Now, if you calculate averagely, it gives you like 17 on its own. So it's not bad. It is already giving above the target on its own, independently, because a quick review would tell you that it is already giving you even better than independent. But does it give when it's combined? Because they ask here as a whole. So let's try the whole part of it. So the whole part of it on independent level, I would accept it if there was no this. But let's see if this is existing already. If it was only this, it's still better than it gives 2% extra based on what it is there. So if you check here, if you combine the whole, let's say this is combined. So the whole will be, let's take this plus this, you get to be equivalent to that. And then we'll have, of course, this here plus this one here, you'll have that. And this is the combined profit of the two. And this is the investment of the two. And subsequently, if you do your analysis, this divided by that, you have it at 16.5. And that will mean not really bad, because it's still better than the other figures. It is 16.5. If you round off, it is close to 17, at least from that. I think this one is purely 17 for that. So that's the case. Now, that's what I'll simply have to put it up as it is. So they have 16%.5, and that's better. And we will advise or recommend to undertake it, because if you compare with the current again, we have compared with the two areas or two factors here. We have compared, as you may say, we have compared with the target, it is better, and compared with the current, and current, it is better. So if you compare with the current, it is better to undertake the investment. So it's better to undertake the investment. So it's better to undertake the investment because it will increase. It will increase. It will increase by 0.5%. 0.5%, and that's better. 0.5% is a huge deal. As you may notice, 16.5 subtract 16. So it will increase from that current status that we are in, is it? So that is better. And even it is higher, of course. All of them have been higher by when you compare the target. So it is not really an issue of that. All of them are still better as per that case. Anyway, if there is a question, that's what it is from that scenario. No issue about that? Okay, so that's what we have, and that is what we need to relate to that. So if you check from that angle, we have all these that is relating to that, and we get it is equals to what it is. Unless there is anybody with a question there, if there isn't, then we can move ahead. So that is one thing that I could advise, that it would be better from that issue, and that is what it will be from what we have. That is what we'll have from it.
I have a question.
Yes.
in the beginning, you have seen that return on investment has a different formula,
How
has
so?
a formulas.
Yes.
Uh, about to this our question here, can we apply any other formula apart from this profit over investment?
Yeah, we have said you can apply return on investment, as I've said, is also referred to as return on capital employed, which is profit element, and then you divide by, of course, the capital employed. That is one way you can also apply this capital employed. Apart from that, you can also use profit divided by investment. Investment basically means is assets, total assets or assets that have invested in. That is what it is, where the money has been invested in terms of that. Apart from that, return on investment can be calculated as you have seen. You have a turnover, you multiply by sales, profit margin. So there are various ways you may apply. If you may check, there are not many. Let me say, somebody may think I'm talking about too many. There is a return on asset also, which you may use, multiply by asset turnover. Before you can try to think about that. So there is return on asset, because that is profit again. Return, let me write the second one. Return on sales, sorry, return on sales, multiply by asset turnover. Asset turnover, because it is about asset. Now, when you check what is a return on sale. Return on sale, of course, will be profit divided by what? Profit divided by sales, which is that is return on sales. When you check assets turnover, turnover is how the assets are relating with the sales. So sales is the numerator, and then divide by total assets, as I may say that. So that is the case there. And when you combine the two, they cancel each other because it's profit, because the idea is this one here, this one. So if you put them together, you divide by sales and then multiply by sales again, and then you divide by total asset, which is that assets and asset could cancel out. Not asset, sell and sales could cancel out. You remain with profit divided by total asset, which goes back to this formula here. So again, in professional, the dynamics are, you have to understand things from the foundation better to know the flexibility of how they can adapt. So if somebody set exam and give me return on sales and they give me assets turnover, I can simply multiply the two and I get return on investment. Assuming somebody has given me assets, return on assets is, let's say, 10%. And they tell me asset turnover is maybe, let's say, certain value. I'll simply multiply and they give me these, as we are saying that for purpose of that. And that is what we are trying to say for that case, in terms of this. So it is only a matter of understanding how it is. So I would say possibly there could be only be one formula, or depending on where you are viewing from, it could break down to different components. It's one formula, but it can be broken down to different components. Let's say that way. Because to me, I don't think it's a separate formula. I only think it's a matter of understanding that it can be read from investment position, where the money went to, or from a finance side, where the money came from. Unless I have not answered the question, but I think I've tried to. If it's, you can tell me if it is satisfactory to your point of what you're asking or to your level.
Yes, it brings to other confusion to me if you say you can you can identify or you can analyze this formula according to where money is coming from and where money is being invested.
Yes.
Explain to me clearly. I'm not getting it.
Just, you know very well, we analyze the reports. We analyze the reports, and the reports are first of all, return on investments is a profit oriented. The profit, the part which measures the return is profit aspect. Then, second, an asset is equivalent to a liability. We say it is equivalent to liabilities. We consider most time long-term liabilities plus equity. So this is where money usually comes from. Money comes from liabilities, the finance. I think you know accounting. It is accounting also is usually we say that. This is where I'm talking about. This is called capital employed. Capital employed is finance. That's why we have what is called managerial finance in our syllabus or in the units we cover. This is a finance. And finance basically means where money is coming from. I think that is what I was trying to say. Where money is you know is a source, or the money, or we can say is a source. Where it is a source. Source. Let me use source. Not source for eating, but source of where it came from. I know there is another source also called for eating, but generally this is the capital employed is source of finance or finance. That's why I'm talking about this. But money does not stay in capital. Money has to move because you are investing. So when you invest, money goes to assets, because that's where we double into the equation start from. So to the assets, money goes to what is called the what? The investments. Assets are equal to investments, and assets are equivalent, let me say, are equivalent to what we call investments. So the general name is investments, and that is what I'm talking about. So, and if you check, why am I saying this? Check the formula. Why would they say it is similar to return on capital employed? Because the formulas are the same. Return on investment calculate profit, divided by investments. That's the meaning of I, ROI, or the implication or indication of I means return on investment. Return on investments means total assets, or what you have invested in, which is assets. And that means it goes along with this abbreviation of ROI. But there is ROCE. Remember, the difference is CE. CE means capital employed. And what is capital employed? Capital employed is where the money comes from. So when I say the other, you can represent it using the source of where the money comes from, which is return on capital employed, or you can present it with where the money went to, because you invest. You don't have capital and keep it in the bank. That is not investment. You have capital, you need to say, okay, let's buy a car, let's buy inventory, let's deposit in our bank, let's pay rent, let's prepay this on that. All those are assets you are trying to invest in, and that's why we call it capital investment. I think I've answered your question. So the difference is, if you check, the difference is this. The difference is this one is capital employed, and this one is investment. But in reality, investments cannot exist if you don't have capital. Can you invest if you don't have capital? No. Yeah?
Yes,
you cannot invest if you don't have capital.
Yes.
Have I answered your question?
Yes, you did. Thank you.
Yes, exactly. So if I've answered, that's good. So I was saying that we look at this from the two dynamics. And most of you know the concept of also double entry and whatever. Money has to come from, if it is your left hand, to go to the right hand. And to the right hand, if money came from my left hand, it means that is my capital employed. Where it goes to is my investment. I have to invest in PPEs, invest in all those current assets and wherever for the business to have what to do. So I have to put in terms of assets. Okay. We kind of said, somebody's asking, we use profit after tax? No, it's just any profit that is given as per that. Any profit. Just a minute, I'm coming. Just let me take water. Oh, sorry. I was speaking some water there. So I was saying that's what it is. You take the figures which you use here, return on investments. I think I've explained that, and that's how we view it. So from the formulas are simply a breakdown of what it could be possibly. As you may think dynamically, I think most of you are also have done reporting. So when we view it from the asset point of view, we call it return, return on investment. But at the same time, you shouldn't be rigid. You can also view it from, if the question gives you capital employed, like liabilities and equity, you also view it from that side, and that is okay, because they are equal to each other. So if you get that, and that's why I am qualifying, they qualified and said, if you check if you check here in the SBA, the open tuition, clearly say they are equivalent. So I've also made sure you understand why they are equivalent. They're equivalent because one views from the side of where the money came to be pumped into the assets. The other one viewed from where the money went, which is the asset side, which is investment. I think I have answered that, is it? So that's why they're equivalent, and that's why when they say they're equivalent, it is because of what the components they carry into their formulas are similar. Any other question? I saw somebody wrote here. Have you asked? You have asked that because you can be required to compute profit, then what do you do? Okay. You see, the idea is this: profit is usually commonly given in most cases, unless it's not given. But profit is one of the easiest components you could calculate if you have all the data given. All you need is to get what is the source of income that is there versus what is the expenses that were charged, and you get the difference, which is that. Again, the profit, if you check in the slide, we say the profit could vary with what it is. Sometimes we use profit before tax because we don't have tax issue. So just make sure it is the profit that is that is profit that has been subjected to all possible expenses, except for, you don't take away dividends and all those cases, but it is a profit that is relating to that issue that you have for that case. Now, for purpose of just making sure that this gets understood, there is a slide which I shared which has ratios. It clearly indicated that. Let me see if I can remind you again. There's a slide which I shared which had ratios. I don't know if it is here. I think it is this one. If you come back, which screen are you seeing? Here, this slide. I shared this slide, and it clearly indicated the issues relating to the question you were asking about profit. We said return on investment can be calculated as EBIT, and you divide by net asset or capital employed. Return on investment can be calculated also as after tax issue, which is EBIT, you take away the tax and then divide by net asset or capital employed. Return on investment can also be calculated as EBITDA, which is earning before interest, depreciation, and tax, and I think plus appreciation. All those cases, you will still be dividing, and you get the issue when you divide with the total assets, divide by, of course, the net asset, which is, of course, the capital employed. On that other side, you may view it from that. So just to make sure that you understand this, you will notice the dynamics of profit have been changing all throughout, or have been subjective to what is given. Let me say subjective. When it is here, it can be EBIT. One time it can be after tax, one time it can be this. And that's why even in the slide here, I put it and I said, in practice, be aware that there are different ways to define profit. A different way to define. So don't be rigid to have just one pattern. Oh, profit should be this. If it's not that, then I can deal with this. No. You deal with what is given as per the subject of the question you have. Like in our question we have here, you could notice they gave us just a profit that we are told is profit. So I really don't mind so much about other issues. I take it as it is and I use it as it is. So the profit is kind of depends again with what it is, as you may notice here in the slide. It is in practice, be aware that there are different ways to define a profit. And that is what you may know as it is. Like in that question, that is how they define the profit, and they say they just called it, or in fact, how they call it, let me see, the words that described it. The words that described it say that Ventspil division is currently making a profit of 82,000. We really didn't mind whether it is after tax or whatever, because we have nothing else to go by. So we just define it as it is, and we moved ahead. I hope I've answered your question on profit. If it's okay, we can move on. Okay, let's move to residual income. Now, I need to move to residual income. Let me take you through the slide just to explain what is residual income, and if you have any other issues. Now, remember, this also case here in the slide which I'll share with you, I've defined some other issues. I've even done this example I was doing somewhere else where I was teaching also this in some other case. So that's why I didn't need to use it. I just wanted to use Open Tuition. As I know, I want to maintain some consistency on that issue. So my consistent was because I started with Open Tuition as my way of getting examples. I'll keep that as my main up to the end probably of that, to keep consistency of where I was using my questions. So that is why I did not pick up with these. But if you check in that slide, I've explained investment is commonly defined as net cost of a long-living asset plus working capital. But I've gone through that, even explain further in practical essence of what we could use from that. And I have explained many other issues. I don't think it's necessary to go back to these issues as a case here. Let me go to residual income. Let me go to residual income. It has advantages, you will see there, and disadvantages, which I think I've explained. It is easily understood by managers, and all those cases make it better. It is comparable to interest rates and the rates of return on investments. Limitations, I don't know why limitation is not coming through. but goal congruency issues, incentive for high return on investment units to invest in projects with return on investment higher than the minimum rate of return, but lower than that. So there's some limitations of goal congruency. It may bring companies to fight between each other. They want to make the best out of each, and the comparability across investment center can be problematic, which is some of the disadvantages it is. So for goal congruency problems, I've explained return on investment has the disincentive for new investment by the most profitable units, because return on investment encourages units to only invest in projects that have higher than the units of current return on investment, which is also the scenario we checked. I compared, if you notice very well, I noticed independently it was making 17%. So that's why I also picked it, because that's why I did in the proposed, if you check in my Excel, we did that. So it is kind of also would be discriminative on such issues. There could be a company which is also performing better, but because it is lower compared to the one which is existing, usually they will not take it up because they are more focused on that, maintaining that return on investment. And it could be even having maybe better issues which are not clearly seen by, because return on investment is more quantitative, sorry. So it may not be picturing everything in terms of all the dynamics. So it may not reflect other issues as it may be. Managers evaluate on return on investment, may reject profitable investments opportunities that dilute their higher return on investment. And that's what I'm also keeping on saying. As you may notice, you are focused mainly on performances, of keeping sure your return on investment is maintained. There could be even a good opportunity, but your focus, because you don't see it in the long term, you see it today. And if it is not making a return on investment that is better, it is not good. Like one time somebody told me about Kodak company used to reject digital cameras. And maybe the digital camera at that time, they seem not to be making money, or at that time, or it was something starting. And then you reject it. Then all of a sudden, Kodak has gone out of, Kodak went out of business, by the way, because they used to use film. Nowadays, we use digital cameras. So you may notice that maybe you are rejecting something, but it has a very good strategic, based on technology, it may be better in the future to come. So that's why we are saying here, it is possible for you to reject something based just on numerics, on figures. But in reality, when you check, in the future, it may have better performances, because maybe today it is because it's starting and you are comparing with your company which has been, or you are comparing with activities which have been there for a prolonged period of time. So that could be also one of the issues. I think you read that and get the issues. Let's go to residual income, because even the question I want to do as both combined. Most questions would easily have them carried along together as a way of measure, including even ever. But the question which I've seen, it has already the two of the three, which is the return on investment and then residual income. Now, residual income. Residual income, also the name has a meaning to what we talk about here. Residual income is an absolute measure. It calculates the balance. It calculates the balance, as the balance is the only figure which is the balance remaining on the income. What does residual income mean? It means you deduct all the other expenses, including the cost of how much you invested, and then you get what is the balance. So in contrast to return on investment, which is a percentage meaning the relative measure, a relative measure performance indicator, residual income is a dollar amount. It measures only absolute. RI, investment center income less an imputed charge for investment, for the investment in the unit. RI, which is residual income, can be interpreted as income earned after the unit has paid a charge for the funds invested in the unit. It is defined, or it can be interpreted as Again, income earned after the unit has paid a charge for the funds invested in the unit. Any money you invest has a cost. The first cost is the operating expenses or the deduction you get as expenses for what you have made. Subsequently, there is also the deduction deduct, which is the capital charge. Those who gave you capital, they also need to be paid, and that's what is called imputed charge. Anyway, this is an exhibit of a formula here, which shows how it is. I don't know why it's not coming. Let me move slowly. Why it is not showing, I don't know why. Let me check why it is not bringing to the screen. But I think I could just refresh. Let me refresh everything for a moment. I don't know why it is not showing that. Maybe it's because I'm using internet or something. Let's see. Went back to the start. Just as I check that. Or I can use the other slide maybe. Just a minute. Okay, so I think it's okay now. Let's see what it will show us. So there is a formula, anyway. The formula is you take all the incomes or the income you got, you deduct all the charges that have come across with it. You deduct all the charges that it has brought you. And that is what I wanted to show. But in the meantime, as it is moving, let's see. So there is an exhibit here to show, which I kind of, it's not coming through, but I can explain it as we go through later on. I'll come back there to check it out and see. I don't know why it's not reflecting, but I'll check that. Let me see here. Oh, it has come. The exhibit, I think, I don't know what happened here. So for example, like this one is the investment. So you take, when they say the computed charge, I think it's this one here. So you take 12%, you multiply with that. This is the cost of capital. We call it minimum return. In some books, those who are doing corporate finance, we call it wachacha, we call it cost of capital, we call it hurdle rate. But generally what it means is the amount you part away with for using somebody else's money or for using your money. There is a charge for every money you use to fund your business. So it is 12% of this, what they invested, you get, it gives them this. They compare with the actual income, they get the residual income. It is as easy as such. But before that, that is just an example. I think it is what I wanted to show. So it is a matter of taking the income you got, which is that you compare with this and get what it will give you. That will be what the formula will be structured on. Now, maybe just to move ahead, here there's an example which I had, but it is not, I think here it was not reflecting. I don't know why, but it is an example just to show what it is. Let's use some example directly from the OpenTuition and see what it entails, as we may maybe find a better way of handling that. We call it residual income, and I can check it out, and we see how we can calculate it, probably from what I have from the OpenTuition. I think OpenTuition is here. So I could check here. There is a, I think I don't need to do this. Let's go here before we took a look at in the past paper and see what it is. So there is a residual income. Instead of using percentage as a return on investment, the residual income approach assesses the manager's absolute profit. It takes only the difference, which is that. However, in order to take account for the capital investment, notional or imputed or pretended, as they say, interest is deducted from the income statement profit figure. The balance remaining is known as residual. Residual means balances, and we call it residual income. And residual means after you have deducted all the issues. So we are going to use an example to see how it works. We are going to use an example. They say we use the examples 1 and 2 above, which means the same examples which we are dealing with that. So let me go back to the Excel and show you how it works from there. I think I forgot to calculate this. I'll come back there and calculate that later because I'm talking about the residual. So this is the same question. We can calculate the same question using residual income. We can calculate this same question using residual income. If you may notice, it is the same question. It is, as they say, Akenya Public Limited Company has division throughout Baltic states. The Ventipils division is currently making a profit of 2,000 per annum. Investment is equal to that. Kenya has a target of return of 15%. The manager of Ventipils is considering a new investment, which is requiring an additional investment of $100,000 and will generate an additional profit of 17,000 per annum. So there's a part. It has two parts actually. Previously, I think when I went to take water or bring the water here, I did not do the second part, but I'll do it here and go back to also the other area and do it. So the idea here, we're going to use what is called residual income. Now, residual income will take, we usually say net profit after tax. This will be the formula, and we deduct what is called imputed charge. Imputed charge as a way of getting what it is, and we get what is called residual income. Imputed charge, how is it computed? Because somebody will ask, what is imputed charge for that case? Imputed charge is computed as such. To give the detail of this, imputed charge. So imputed charge is actually what are you paying your investors? So you take wachacha, or generally cost of capital, as it may be called, cost of capital, and you deduct, you multiply with the, the amount that has been invested. So the amount invested could be through capital employed. If it is not capital employed, which is the finance side, it could be through investments, which is assets, which is also could mean the assets you have invested in, and that could be there. So you take how much am I getting from my investments, which could be from the source of how you finance to that. So from that area, I think that is what I need to tell you from that. And I think you can easily now calculate this, and then we use it as it is. So let's see how to calculate this, and then probably from that area, I think you are all on the Excel, and then we see how do we deal with it from that, and we compare the two and see which is which from that case. So since that is the case that we have there, I think one of the issues is let's calculate and see. So first thing first, let's get the data. What is the operating profit? Net operating profit, or simply the profit given, is given as 82,000, as you may see. Now, from there, that is because we need to test the proposal, we can call this the current status. The current status. So this current status, we have also to check and see. Now, if you check there, they are saying Anika has a target of this. So they are targeting to get this for every amount they invest. So we'll use this as a capital employed because it is what they want to get from it at a minimum. It is also called minimum return or something like that. So we'll calculate less imputed charge, which is going to be, as you may see there, imputed charge, which is going to take either cost of capital or a minimum return, as you may take that. So we'll take the 15%. 15% is same as what they want from the business, which is same as the cost of what the capital providers are that are requesting for. So take 15% multiplied by 500,000, and you get is equals to 75. Now put this into a negative form because you want to deduct it, and when you get that, the difference is 7,000, and that is the RI, which is the return on investment. At the current status, proposed, let's test proposed independently first, because it's possible to do that. The proposed will give us, as you may notice, the proposed will give us the $17,000, sorry, and then you need to deduct from 100,000 multiplied by, as you may notice, the target is still they are saying is said to be 15%, what they want. So therefore, this means this minus that plus, because I've put already minus on the figure. So plus this, you get it is 2,000, which of course you may notice still not bad. It is still giving higher than that. When you use absolute performances, it is still better. Now, when you do the combined, the combined here basically would also give us a data we can work with. And the data we can work with is we'll take the two profits and combine them and then deduct them. So we presume that the profits will be will have a relationship of additional, which is this plus this, and we have that. So it gives us that figure. And the total amount invested in the brackets will have 100,000 plus 500, which is 600, close the brackets, multiply by 15%. Multiply by 15%, you get 90. I think that put a negative there. So overall, it is this plus this, you get, it gives you 9,000, and that is what we have for the profit element, which is that, and for the imputed charge, which is equals to that. Therefore, we will say it is okay because it still gives better, and even it adds 2,000 because the 2,000 came from here. And we'll propose that we recommend that it could be better if they undertake it. So recommendation will be that it will increase. So we can recommend the proposal to be undertaken. The proposal or the proposed should be undertaken as it will increase, should be undertaken. Unless there's any question there, that's what it is. Residual income. Before I do part B of it, should be undertaken. Why? To support my answer, I've said that the reason is that it will increase. It will increase the RI. It will increase the RI by, of course, 2,000. As you may notice, it increased by 2,000. If you compare this and that, where did I get the 2,000? It is, of course, if you take the figure there, you deduct, which is take the figure there, which is 9,000, and minus, of course, the 7,000 which they get there. So it means there is an incremental of course, that figure, which is 2,000 from that area. So it would be better to undertake the project. Question? So because it's an absolute measure, as long as it is positive, it is taken. When you do relative measure, maybe there could be other ISO interpreted, because relative measure now is about how much you put in versus what you are getting. But all of it should be undertaken from that. Now, if there's no question, that is what is called the residual income. You fix it like that, you get your issues. But because I say we use the same question, so here it means I need to calculate B. But B, I'm not calculating return on investment. I'm not calculating residual. I'm calculating, just let me paste here first. I'm calculating minus the zero or the O part, sorry. The O part, let me remove it. So I'm calculating return, residual income of the division with and without the new investment, and hence determine whether or not the manager should decide to accept the new investments. I think I've already calculated that. I've already calculated, because the first one was asking calculate whether or not the new investment is attractive to the company. Oh, I calculated everything actually. I sold everything. Because here it was only for the whole, which I sold here. The whole is combined. So I sold it. And here they're saying as independently, which I've done. I've done this and done that. So I sold it. Even here, I think I sold everything. So I sold all of it. I sold also including B. If it's the same question they're asking, I sold also B. So I've actually sold including B. Actually, I was doing it just, but I've actually sold all. Because I've calculated when they're independent, which is this, and I've calculated as this one here, and then I did the whole, which is the required one. So I've already done independently as a division and even advised on this basis of those. So unless there's anybody with a question, if there isn't, that is the structure of how, or that is how we apply the return on investments and the residual income. Question, before we go to the past paper. There's a question in the past paper. We need to check it out, as there could be a bunch of them, actually many of them there. So we can check out and see before we go to economic value added. I saw there's a question independently asking the two aspects. I picked the recent paper actually. So I just, but there could be others in the previous and all those cases, which I can leave for you to do the practice. As you may notice, it's just about understanding what is return on investment. It is you take the profit you have, you take away the charges which are being charged by capital providers, and you find what is the balance. Return on investment is a relative measure. You just take the profit that is given at any period of time, divide by the investments you have or capital employed. Or you could use also the sales as a profit relation of sales, and the turnover, which is also the relation of assets with the sales. So if there's no question, that's an example we may undertake from that. No question. Okay. If you don't have a question, always the examiner has questions. If you don't have the question, the examiner has the questions. I want to check in the examiner the issues, and then we see how we can deal with some questions. Now, I've made a summary of the possible questions that are there, but I used only an analysis from 2020. I don't know if I include 2023, all of it, but if you check, there are questions which relate to that. I've summarized here. Some of them are around return on investments, which I've already factored in. Like there is return on investment. There is April 2021. There is a return on investment only. There is this is residual solely. Residual is only April 2021. One question was tested on it alone, on its own. And then there is one time they said also, which is also in April. I think there is also April, which has question on also that. As I told you, they like to set them all two together. One time they set a question which has both, which is July 2022. And also there is also November 2022. So I have all those questions which are here. November 2022, there's a question. July 2022, there's a question. And then April 2021, there's a question. And you could see how they could be in relation to that. There are questions which relate to that, and you could use it as a case. Now, let me pick this one because I want to kill two birds at the same time. So let me use also the recent one, which is November. I could use November as a way of making sure we solve something from the past paper. I would pick kind of November, which I could use from that case. If you don't have a question, let's use November as a basis of trying to get what could be solved from there. So November 2022, there is a question there. I think let me take you to the PDF. You could download it if you could get it, but it is here. So let's move down here. Actually, the question that came on performance were two questions actually that here, or two areas. It affected two areas. Because if you check here, It is part of also question, the compulsory, is it compulsory part? Let me see. About Ramagana best joke, something. I think this was part 1.
It is question 4. Question 4.
Question 4. But also, yes. I was just saying, it affected also this part of break-even here, because it's a profitability measure. If you check also this one here, it was affected. This about Ramagana something, because if you check down here, they'd also mention about it here, and they needed the students to also use it in its context inside here. So it came and affected also some other marks here, like 4 marks. But apart from that, it also came independently, as you are saying, in question 4. In question 4, it came independently alone, but it affected also the compulsory area to some extent. Now, one of the things is that I've said again, make sure you remember the formulas of what it takes through, because you'll be given the figures. Remember, we are doing evaluation, so most times they try to give you the report, so it is you to analyze it, unless on certain occasion they tell you to start from scratch to calculate the profit. So it is question 4. I think it's this one here. This one is on EVA, and it could be, is it question 4 really? Because we have not done EVA. Oh, this was asking also discuss the problems that may be involved in comparing divisional performance on this. I've told you the limitation, like return on investment, it is, you know, sometimes it may, you know, conflict on goal congruency, and sometimes it uses what is called historical data, which makes it difficult for it to make future, you know, strategic decisions and all those cases. While residual income, it is absolute measure. So when it is just above a certain figure, they accept, but sometimes maybe it may not portray the true picture of how much you invested versus it is not giving a relative measure. Anyway, I'll give you the limitations, we'll check. I think this is on EVA. Apart from the other one down there, I think the one that I'm talking about is not that. It is to be, I wanted where there is calculation about, I think it's not this, maybe it is July, yeah? This one, the one that we have calculation, this we'll do in class about the break-even. This one about Ramagana chokes something we will do in class, because in the next session we'll be doing break-even. So I don't want to touch it now. I'll leave it because it is connected to break-even majority of the test here. 9 and probably max is from the break-even issue. I think it could be July. If it is not that one, then it is July. Let me bring the other paper, which is on July, because this one, the calculation part I was checking for is not that one. If you check, they're asking for limitations, which is not what I thought I should be discussing. I want a calculation question, which could be carrying the more marks of that. Let's check July. Let me check July. I could easily, let me download July. It is coming from July. I check July here. Oh, I have it. I have seen I have July here. July, it's here. I had actually downloaded it. Is this one here? So we are using July because July has calculation, and probably it is what I want, and it carried more marks for that case. Let's use July, yeah? Because in November, it's more theoretical. You just need to explain limitations. And limitations, I think you can even give more as you understand the formulas and the concept. But my main issue is to show how to use it in calculation also, which is what could carry most of the marks, apart from just explaining the theory issues, which could also be understood as long as we have discussed. So it is July, and I think it is question number 1, because it's under section 1C. Is it 1C? This is 1B. 1B, I think we did it in class the other day, for those who are in Kigali. 1C, yeah, it is 1C, because 1C is where they're asking about 7 marks, which is on return on investment. and then there's 4 marks on a residual, and then three marks on explaining other methods that could be there apart from what you have been given there. So it carried like 7 marks plus 4 marks, that is 11 marks plus 3 marks. We have almost what we say 14 marks of the 50 marks that was set in that period, probably with others, if I'm not wrong from that case. But that is the average it carried from that. So required, calculate the annualized return on investment. Calculate the annualized return on investment for the division D and N. Discuss their relative performance using return on investment, and the other information given above. You get 7 marks for that. Calculate, that is number 2. Calculate the annualized residual income for the division D and the division N, and explain the implication of this information for the evaluation of the division performances. Number 3, explain 3 other methods that can be used for the division performances that could be used in additional to return on investment or residual income. We have EVA, we have balance scorecards, or all those can be used, which are also part of what could be used as per this case. So there are other methods you could explain which could be used, and there are not. It's not only that. We have a balance scorecard, we have benchmarking, we have EVA. All those could be used from that, and the many others which you could explain, like ratios and stuff like that. So on division, but division performances would use mostly EVA, balance scorecard. There could be other non-financial also performances. If they want only that, we could also explain that. So let's go to the issues here. Up here, we have question number 1C of July 2022. This is what they gave as the question itself, or the case study, or the scenario itself. D and N are other division operating in Rusizi Group. These divisions have been created as investment centers, and they operate in similar markets. Management on monthly basis should prepare and submit operating statement to the central authority of the company. Below are the operating, let me put like this, I think zooming in would be better. Below are operating statement for the month of February of the 2 divisions. So we have the 2 divisions. There's a division named N, a division named D. So there is sales, there is variable cost, there is contribution, controllable fixed cost, and then there is controllable income, apportioned central cost, and we have all that. Controllable fixed cost means you can control it, and that's why you can segregate it. And then there is controllable income, which is given there. Apportioned central cost is 160, the figure that there 169 and 90. Net income before tax is 61. Divisional net assets are given there, that is similar as capital employed. And then Rusizi Group has a target return on capital of 10% per annum. Currently, Rusizi Group believes its cost of capital is likely to rise, and this and is considering increasing the target return on capital employed. The current policy is that the divisional management and performance are primarily assessed based on the results of their respective return on investments. So we have that as an issue. Now we need to, of course, jump into and see how to relate to this. Now, one of the things you need to remember is the formula, and also you need to remember the formula for this case here. Let's go and try to solve it out from this case here. If you come here, I tried to, I think I had copy pasted somewhere here, just some few minutes before we met. It's here. Actually, I had forgotten. That's why I was not remembering that it is which year. I didn't recall properly what it was. But I think I could name here before I share the Excel. This is July 2022. And this is that. And this is okay, this is analysis of other things. So here, there is D and N, as we have noticed, that's what they have. So basically it means if you take this, that is what I can presume that if you take this and minus that, it should give you that. And similarly to what is there, which is giving you, I think, if you check, should be able to give you that. Eh? So the controllable issues and all that, just I'm cross-checking that. So you'll have the apportion cost with that. Net income is this before taxes. So basically, let me confirm if it is that way. You minus, of course, the fixed cost and the plus. Is it other relating to that? I think it is something relating to this. Let me see. So they've said the net income before tax is that. So probably it means they took this, which is the figure there. Of course, they rounded off. So it's kind of rounding off issues. And then they had, of course, to deduct this. And they say that is controllable income for that case. So what they did, I think they minused also this, is it? Which is that. So they got 61. And similarly, they have also taken this and minus this and minus, of course, this and minus that and got, I think that is, there is an issue there. They minus too much. Just a moment. So anyway, that's what it is there. I think that's what you have. I think it gives you 11 for that case. And that is what it is for that. Eh? So from that 11 or 10.5, if you just would round off to that, that will be the case. So we need to use it to calculate. We need to use it to calculate the return on investment. Now, investment is given there. So we have the two divisions. There is a division. Let's provide some solution to that. I could provide cross it. The solution is this. So we have the division here, which is that, and we have another division, which is this. So we need to calculate that. Eh? So we need to pick what we need to have, which is a profit. Let me bring them here. There is a net income before tax. That is the profit component, which is 61. If you remember the formula, return on investment, you have to call the formula first. Return on investment, if you may check, is supposed to be profit. And we say profit could depend on by what is defined in the question. So like in this case, we divide by total assets, or in this case, as per given there, as if I customize, I'll use the net assets. I'll use the net assets according to what they have for the divisional issue there. So this is equals to also this. You also have that. Next is that you have divisional net assets, which you get that, which is equals to this, and this is equals to that, which is there. So of course, next would be just I need to get this being done, which is return on investments, which is of course the profit element that I have, which is the net income as it is referred to as there, and how is defined is that one, and then we divide by the net assets as we check into that. So if we check that, we could use that, and that could be our agenda there. So we'll take this, we divide by this, and we have our figure there. You could percentage it. So we could just say that is a percentage for that. And I think it is giving us that figure there, because we have taken this and use it to divide and get it is giving us that, which seems to be like not really, higher than what we thought. And then you have this, and then we divide by what you have on that case, which will give us, of course, what we'll have from that point, which will be that 2% for that case. So that's what we have as per the given. We have the net income, which is before taxes. We don't have taxes, so don't really stress yourself about the taxes unless it is a given. Then you may need to also use it and say, let's just deduct. As I said, the profit is defined based on what is given there. So it depends with what you're given. So our profit being that it is that way, unless there is anybody with a question there, before we go to the residual, and then probably interpret what it is, both sides. Question? No question? Any question? So if there's no question, I think
Sir,
yes, please.
how the net income before tax is obtained from the question?
How net
income before tax is obtained from the question. That is 61 and 10.5.
61 and 10.5. 61 and 10.5 was after they deducted all the figures that are up there. I tried to calculate it, and I got that. I think it's the same if you check in the PDF, because I've not gone to confirm with the PDF, but if you check in the PDF, it should be the same, is it? It should be the same for that. But there is something, as you are also asking, there is an issue. This profit I've just seen is per month. This profit is per month. I need to multiply here by 12. I got something which I need to factor in. They say they want us to annualize. I've just checked somewhere here. It is saying annualize here. I need to multiply by 12. I need to multiply by averagely 12. So it will be that way. Because this they have said here we analyze, meaning we are doing, because even this one is per annum. I just saw the word per annum, and then I checked here, I realized this is for only 1 month, meaning we'll presume or we'll assume that all will be in that form. Now, how they got 61 again? They deducted all these. If you check again, they deducted that figure there, and they took all that and deducted all the figures that are down there. And that's what they did. That's how they did and deducted that. If you check, I've tried to put in the formula of how they got the 61. How they got the 61. They took the figure there, which is a contribution, subtract fixed, and subtract apportioned central cost. I think if you have your calculator, if you do that, you'll get 61. Is it? Or 60.5 something, which is similar to.
Yes.
Yes. That's how they did that. They did it. It's 61 actually, exactly. Then here again, it is the same. They deducted that and they got that. They did not involve in this controllable income, maybe because maybe it is for something else, but based on what we have, that's what they did. So we take only, as I said, mostly for performances, we take what they have given us and do an analysis on it, unless they tell us to go and recalculate it, or they take it into other issues. But we are taking that, since it is the net, then they have already deducted what it is.
Excuse
So
me.
it's 50. Yes.
The controllable income is the contribution minus fixed cost.
No, the controllable, as you may check, the controllable income, when you come into what you have here, I've not checked it, but you can go check it, but I don't think it's minus fixed cost. Let me see, is it? Yeah, it says minus fixed cost, really. Yeah, to give it 30. It will give it 30 as it is. It is, you're correct about that. It is computed as such, which is also giving us those figures, meaning this was calculated. Let's put some maybe double line there from that. So it means they stopped here and then deducted this letter and then got this, so that can put here some double lines to show that it's computed. There's a movement between this and that, and this was also computed as a movement or as an operation side. So it will be that way from that case, implying that if you take also this, I think if you take also this, you minus by that, you should be getting the 61, is it? If you do that, because they stopped here and then deducted this, and then you get what it is from that area. So if that is the case, it could be also, that is also another analysis of viewing it from that case. So it is 15% and 20%. 15% and 20% per annum, because we are supposed to, convert it or put it in per annum basis. So unless there is any other question, so to give us 15 and that. And from purpose of explaining, because you need to, if you look at the required, it has two things you need to answer. One is I calculate, which is very mechanical, which I've done. After that, you need to discuss. You need to discuss the relative performances of the above information, from the above information. Meaning, you will talk about 10%, of course, and compare with this, and say all of them are performing better. I'll type probably that later because it may take some time for me to do that. But generally, they are performing better, is it? This one is performing better than the 10% projected or targeted. So they are better. So you will talk in that angle. And of course, you will say that the company is doing well in terms of it's benchmarked or it's targeted. Because you have earned here, you have to explain and discuss the issues also relating to that. Discuss their relative performances and their information and other information given. So you have to talk with in that, or you have to discuss your issues relating to this.
Excuse me.
Yes.
For the case of division N, is it 20%? 20% or was 2% annually? It's supposed to be 24%.
Now, I multiply the figure here. I multiply the figure here, unless you are saying, you are asking if you multiply percentage down here, but I multiply the figure to extend it. If you multiply that and if you use it, I think they should give an average of something close to that. If you're multiplying percentage, because from what I'm hearing is like you multiply the percentages, it still gives 20%. Even if you multiply the percentage, it's 20%. I think it is not directly 2%. There could be something inside it. If I remove the 12%, I think it could be something is actually 1.6. Is 1.67. So it's not exactly 2. It's a round of issues. So it could be when you multiply, you get it goes to be that figure. So just it is maybe a round of issues. Somebody who used 2% exactly maybe could get that. But if you do multiply it that, so you may multiply from the top here on the numerics, or you adjust from the bottom of the percentage. So that is what it will give us, and that is what we go to extend it, because it's supposed to be per annum, while the data given was per month, and that's why we did it that way. So it's supposed to be per annum. Anyway, if there is no question on that, I've said your discussion, I'll attach the discussions here later, because I need to write words explaining, oh, it is better, blah, 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 it is giving better than this, measure, do comparative with this, and all those cases. But I may not type that, it will take some time. I'll type that and share later before I share. But I know you can explain it now. When you have the figures, you can put the number, the words in proper perspective better. So anyway, there is number 2. Number 2, I need to calculate what is called the residual income. As you may remember, the residual income is you take the profit that you are given, as you may take it. Usually we call it general name we call it net profit after operating profit after tax. Then we deduct what is called imputed charges. That's what we do. So, and to do that, go to the equation and pick all the data. You can put them horizontally if you want to, so that we may name them. So I want to pick I will pick the way they named it. They say it is profit after tax, which is the before tax. We don't have tax, so don't care about it. Just care with what it is. As we say, profit is defined by what it is also there, or by how the question is putting as it is. So we still stick with it. So don't stress yourself starting to wonder about the taxes. So take it as such. Now remember, we're supposed to calculate per annum. So it is analyzed. So we could pick this already is analyzed here. And we could pick this because already analyzed in form of that, which is this multiplied by that. Now we need to less the imputed. We need to less the imputed charge. We need to less the imputed charge. Imputed charge, and this is an absolute measure, meaning it is measuring according
Sorry, Stan.
Yes.
as this formula say that the residual income is net profit after tax, but we are taking this net income before tax. Is it the same?
Now, for purpose of flexibility, remember, there is some time I talked about the profit issue. We said that the profit depends on basically, or it depends on how it is defined. It's the same case also here. If you check in the slide which I shared with you, which I'll share with you later, I have explained that definitely the profit usually depends, I think, I don't know where I placed it, but generally I had explained something about it here. Maybe it is this. No, it is not this. It is this one here. If you check in the slide, which I was sharing with you, I'll say the profit depends with what it is, how it is defined. Somehow, even in what is called the return on investment, some people call it, or they say it is a profit after tax. Some people say it's profit before tax. But again, it is the same scenario. It's the same scenario also which you go through. And if you check, I think I've explained it somewhere, maybe here, under here. I've said, in practice, be aware that there are different ways to define the profit. So here, the profit has been defined that way. If you check, you have no much option, or you have no option but to use it, because it is defined as such. We don't have taxes given in the question. Do you have taxes given? No, there's no taxes given. So that's why I was saying, don't stress yourself about that issue. Just pick what is regarded as profit. Again, which I've said here again. In practice, be aware that there are different ways to define the profit. It's the same logic also. The profit here is defined as simply as this. And we don't have taxes, so I wouldn't worry about that. I'll pick anything that is taking me to that profit, unless I'm given plus 30% or some percentage which I need to use as a basis of that. So anyway, if that answers your question, so the profits you already have, imputed charges. You take this, multiply, as I said, you take, how do you calculate imputed charges? Imputed charges, you take what has been invested. What has been invested, multiply by either wachacha or or what is called they want as cost of capital. Cost of capital. Cost of capital is same as wachacha. Wachacha is simply to say is an average. Average. But wachacha is cost of capital, and cost of capital is a general name. But because we average it, we just say, let's call it wachacha based on how we calculated it, but it's the cost of capital. So here, our group has targeted this. This is what they want, which is also referred to as capital, cost of capital, what they have targeted. They have targeted, they want 10%, and 10% of these figures here. Sorry, I need to put multiplication of this here is what they want. And that is what we'll have as our figure. Similarly, also here, they have targeted, they want 10%, and 10% is what they are targeting, and targeting on how much they have invested, which is equal to that. Now, you need to take the two, subtract them. This minus that gives you this. And similarly, I could just take it that way, and it gives you 63, and the other one would give you what it is. So these are the residual income. These are the residual income. This is the return on investment as it is. So unless there's any question, you do that, you get your marks for that. And here you can explain other methods you may use. You can use EVA. You can use balance scorecard, because also those ones can be used. Balance scorecard, other measures. We'll go through balance scorecard later. Balance scorecard, you can use benchmarking. You can use benchmarking. You can use all other methods. You can use ratios to measure some of those issues. You can use all that as a basis of trying to measure and see. There could be more. Is just a matter of mentioning that. Any question?
Question, sir.
Yes.
Which rate did we use when we were calculating imputed charges? Is it that 10%?
Yes, you use 10%. Why? Let's first of all understand how is imputed charges calculated. Imputed charges. Let me define what is imputed charges. Is an amount that is estimated that the investor want from what they have invested. So is usually calculated by cost of capital. Is an amount that the capital providers, if you invest, there is what you want, which is qualified through percentages. The capital providers would wish, or are expected, would expect, let me use the word expected, expected to get from an investment, That is what it is. Any capital providers. And what does this mean? It is calculated as cost of capital. Remember, cost of capital has various names. Cost of capital multiplied by what? By capital employed. What do you employ? That is number one. Or if depending on the flexibility of the question. Or cost of capital, which is also wachacha, multiplied by what? By assets. Assets employed, which is also reinvestments, where you have invested your money. Because it is what you want from your investments. Or those are the ways it is. Or cost of capital can also be wachacha and all that. Now, why did I use this? Because this is about Rusizi Group. DNA is part of Rusizi Group. So what do Rusizi Group want as capital providers? They want this target here. Rusizi has a target return of 10%, meaning that is the cost of capital of Rusizi, what they want as investors. Rusizis are the investors. So they want 10%. Answered? Is it okay? So I used 10% and I've explained the reason why.
Yes. Thank you.
Okay, good. So we can go to economic value added if there's no question on this. As I've said, here it is a matter of formula only, and you are able to factor in the figures and you get what it is. So the words or adding on the theories, I'll add later before I send it. I'll add some theories here to support some of the issues asked here. Because remember, it's not only about calculating, they asked also explain the implications, which I'll explain. All of them are performing better, and even they are performing better than what is anticipated from those investors. So it's better. Eh? So we go to economic value added, if there is no question on it, because also my intention was to cover that. Right? Now, economic value added, I could go to it and explain also it. And even there is a question. If time allows me, I'll of course try to focus on the question that is there and see how it is. So there is economic value added. Now, all of those methods have limitations, like residual income has some limitations, which I think will come in later from that. Mainly disadvantages, and there is disadvantages that they carry or limitations that they carry across, which are always make them not be perfect as you may think. So anyway, it supports incentives to accept all the projects. When the return on investment is, of course, greater than minimum rate of return, you could use that and can use minimum rate of return to adjust the difference in risk. So can use different minimum rate of return for different types of assets. Now, favor large units when the minimum rate of return is low. That is the case. And not as intuitive as return on investment. Why? Because it is absolute measure. It is difficult to obtain minimum rate of return at a subunit level. It is very difficult. Like you have just asked me, How did I use, which cost of capital did I use? I told you 10%. But it's very difficult to calculate cost of capital over like a marketing department. It's very difficult. Very difficult to calculate cost of capital. Practically is a big challenge to know what is the cost of capital of that. So most times is assumed, estimated, and all those cases. They make it be as it is. I think that's what I could do for that. Now, this example, which is here, I think I did it in some other areas. So that is the case. Advantages, it is more like, which will go through those. And there are some disadvantages which are put in that. Let me go to economic value added so that I can move with time. You know, I can see time is really kind of also moving. It's almost 8. And I know 8 is when people start to get tired. So economic value added is a business unit income after tax and after deduction after deducting the cost of capital. EVA was, of course, discovered by this guy called, it's a trademark of mark of Stannard and Stewart and Company. EVA approximate an economic profit. So we use economic terms here. Now remember, there are 3 words here. Economic value added. So it means it is compared from certain area to you to say it is added. So it is not possible for you to say it is added when it is not having another year running through. But unless the year is 0, then you will say I have added from 0 to this. So where it means it is the beginning. But commonly they give you a transition of 2 periods at least for you to get the added amount of the economic terms. So economic value added means it is a value added based on economic terms, meaning is added from one point to another. So EVA involves numerous adjustments. The numerous adjustments are because they try to adapt the economical concept, the economic concept of what could be, what the economy view as what to be deducted and what not to be deducted. So they involves numeral adjustments to report the accounting income. So we do adjustment, and the level of investments also we do adjustment in relation to that. Similar to residual income and EVA, similar to residual income, EVA motivates manager to increase investment as long as the expected return in terms of money above cost of capital is positive. So it's almost like an NPV measure, because NPV also measures when it's positive, you accept. So economic value added, you take net profit after tax, but we do adjustment here. I'll put it before I send it. Sorry, I think I moved away. There's an adjustment done here. Then you take the value which you have, which is called K here, and multiply. K is the cost of capital, not cost of capital. K is the capital employed, and then you take away the investment. I'll put it properly later on before I say it. So net profit after tax is after tax cash operating income. Mostly we use cash flow. So those who are doing finance, we do cash flow, and cash flow is adjusted also. And even those who are doing reporting, we always adjust some things here. So these adjustments, the adjustment here is to make sure the profit is viewed as a cash, not as just profit, which is the difference between the movement. So we do the cash operating income after depreciation and all the adjustments will be done. But we take away depreciation only for the tax. So revenue, take away cash operating costs, and then take away depreciation and take away cash tax on operating income. So K is the minimum return, and we multiply it with the average investment capital. So that's what K I was trying to explain here. And EVA is equals to, of course, you have to calculate that and you get what it is from that issue, which will give you what it will be as you deal with it. So that's how EVA is calculated. But there are some adjustments. I wish to go back to the Open Tuition just to explain those adjustments properly one by one as a reference. The Open Tuition has some summary there. I usually find it maybe quite conducive for that. Let me admit some people. Just excuse me. Just a minute. Go here. Let me use this, not this. Okay, so I've admitted them. Okay, in the open tuition, there are adjustments explained there. I'll use those ones. I'll also attach them. I've attached them in the slide, but I want to use an example there, so I prefer to go there immediately and try to use it as a basis of that. So there is economic value added. Let's go through the open tuition just as a quick summary again, which you could use also to gather more knowledge. Economic value added is a performance metric that is very similar in approach to residual income and is defined as being ever is equals to net operating profit after tax with plus or minus adjustments which are done, and then take away the wachacha, which is multiplied by the capital employed, which looks similar as what you do when you do the residual income, because you take this profit, although the difference is that there is no adjustments done on residual. Residual has no adjustment done on it as far as I'm concerned, but for the ever, there's adjustment to make it adapt to what is called economic perception of things. So ever is a trademark which was developed by this guy who was a consultant called Stan and Stewart Company. The principle behind is that business is only really created a business. The principle behind it is that a business is only real created value if its profit is in excess of the minimum rate of return that the shareholders and the debit holders could get by investing in other securities for comparable risk. So the idea is that if you invest and you get excess, because what is the meaning of business? Is you need to invest and your investments grow or are giving you higher than what you put in. And that is what economic value added is doing. What did you add to what you invested? That makes sense to be in the business. Capital employed is, of course, is the opening capital employed adjusted from the items set out below. So EVA allows management decisions to be modeled and monitored and communicate and compensated in a single and consistent way, always terms of value added to the shareholder investment. However, EVA makes certain adjustments because certain types of expenditure which appear in the statement of profit and loss, profit and loss under international, I think it should be international accounting standards, which is IAS. Somebody wrote S should come after. And then IFRS are not regarded as expenses when using EVA. And cash accounting is regarded as more reliable. So they try as much as to do to adapt cash accounting, meaning that is also why the adjustments are done. Adjustments are done because they want to eliminate some of the issues done, especially estimations and all that, done because of the international accounting standard, which are not applied by economic factors, of course, based on cash basis, and that's the issue. So there are major adjustments we do. On profits, we add expenditure on expenditure, of course, is expense on building for future, expenditure on building for the future, expenditure on building for the future, e.g., research expenditure, marketing expenditure, and staff training. What do they mean by this? Any expenditure that is building the future, any expenditure that is building the future. This building is not house, eh? You know English, there's some words used to mean two things. So here it is building means to, not the house actually, it is means, they say, is it to make or to do whatever, is it Kubak or something like that? Probably that, to build the future. So there is research expenditure. The research is, of course, making people be creative and all that. Marketing is to increase the volume of your resources. Staff training is to make sure the staff are becoming more resourceful to the company. So it is improving your economical terms, and that's why we add back. Number two, non-cash expenses. As we said, they advocate for cash basis a lot. So they don't believe in estimations, which is, they believe it is more based on subjective issues. Provisions are also part of non-cash issues because they are only provided for. Goodwill written off. Goodwill written off, it is reversed back and added. Why? Because goodwill comes from you making better of your environment and increasing your business resources. Goodwill comes when you are doing well. So it means you did well because you improve your resources. Depreciation. Depreciation, add back depreciation, book depreciation. Book depreciation means we could call it accountant depreciation, and deduct economic depreciation. So there is they contrast, or these two can fight for the space. One is that there is depreciation, which is computed by the books, which is, we can call it accountant depreciation. Then there's a depreciation which is calculated by economical factors, which is called economical depreciation. So if they are different, if the economic depreciation is not given, then we always assume it is the book value. There was no difference. That is the case. Assume it is the same as the book value, and there is no net adjustment. If it's not given, just assume, okay, we must deduct something. So deduct whatever is given and also move ahead and move on. But if it is given,
Sir,
yes.
what's the difference between book depreciation and economic depreciation?
From my point of view, book depreciation is depreciation calculated by accountant. Remember, or by company policy. Let's say company policies, which most likely we can call accountant depreciation. Sorry. Remember, we don't operate we do analysis on already computed data. We do analysis on already computed data. And the data which are maintained by, because we get this data from financial reports, or we get this data from accountants, and these accountants have maintained this under the standards. Generally, the statements we are given are standard already presented by the standard, or are already manifesting what the standard applies, meaning that they already are prepared based on the standard with incorporation of the policies of the company. So when you say the book depreciation, we mean the one that we found existing in the books, and probably who calculated it? Accountant. So we could call it simply accountant because it's calculated by accountant. So sometimes it's called accountant, sometimes it's called book because it's coming from the book. So it could be called many names based on, as long as it is, one we found there, and we found it in various ways. One way, we found it in the books, so we call it book. Another way, because it was computed by accountant, we call it accountant issue. Then the economic depreciation is calculated by economical factors, meaning they use economical pillars. I'm yet to really find out what are these economical pillars that calculate depreciation as such, because I'm not really an economist as such, but they always give you, that is the best thing. They never tell you to calculate it, so you are given. So, anybody who is an economist maybe could tell us, but I'm more like there is an economics pillars which are used to calculate that. So if there is a difference, for example, if the economy is 100, let's say 1,000, let's say 100, and the other one is 80, there's a difference of 20. So you must adjust that 20. You must either, or one way, you could add back the book depreciation and then subtract now the economic depreciation, or find the net difference, which is 20, and find who is carrying the day. Is the 20 coming because the economic is excess, or is coming because book is excess, and do the corresponding adjustments. So that's the difference. Now we can move to, yes.
Excuse me, sir.
You excuse?
There is a definition that says economic depreciation is asset wear and tear beyond its expected capacity. That means if you planned that it will tear 20%, but it tears more than that, that is what is called economic depreciation.
Really?
Yeah.
That one I must check that definition. Beyond its capacity. I'll have to check. I'll have to research that. I have to research that. I have been I think I have to research that properly, because that is a kind of new to me. Beyond its capacity, that will mean to be negative. If it is beyond its capacity, they will have written off
beyond what is planned.
beyond
When
what
there
is
is a
planned.
wear and tear that is beyond what had been. Yes.
Okay, it could be okay. That's I'll research that to find out basically how it is. But despite that definition, the question is, how do they calculate it? That could be maybe also the case, because it's a value. How do they calculate it is what I was also trying to highlight, as we actually really not have so much idea about it unless you're an economist. But the good thing, as I was saying, they give us direct data relating to that. So that's the idea. So they only want you to arrange it to know what you need to do to adjust it to suit the economical terms. So they usually give us, hardly would they ask you to calculate it, because the concept here is that we are not doing economics. We are more like just applying something which could be there, is it? Or strategic performance, meeting it. So anyway, I'll research back and try to find out how do they calculate it, maybe for my own interest of knowledge, but they don't usually ask us to do that. But that's a good definition. I'll check it out to confirm what I'll prefer to know the calculation later on. So there is interest on debt capital. Interest on debt capital is added back. Why? Later on, I'll share the book called Calling the Rule, but which has also further explanation on each of these components. But I can say again why it is added. Because in the Wachacha, we usually deduct it. So why add it? They say it will double up the issue. So why add it again? Why deduct it when it's relating to that? For those who are doing, I know most of you have passed through the process where we do what is called the managerial finance and the corporate finance issues. I think you know how Wachacha is computed, and Wachacha is computed where they take the debt and minus away they take the cost of the weighted average of equity multiplied by cost of equity, and then plus weighted average of debt. Then they take debt, cost of debt, take away one minus they say one minus tax, meaning they offset, and that's why they are saying it is deducted there, or it is already factored in there. So it's already factored in there when they take the cost of debt multiplied by weight of debt. So it is factored in. So they say you don't need to deduct it, it will be doubling. And doubling will mean you don't get the correct answer. So it's better you cancel one and remain with one. So that's why we cancel the one as an expense and remain with one in the cost of capital, which will be deducted, which will be deducted here. Will be deducted here. So I've explained why we add it, because it will be deducted through Wachacha. Anybody who doesn't know Wachacha knows that you could remember it. It is a popular aspect of finance management or any finance area of cost of capital. So add the net profit after deducting, after adjusting for any tax relief. Treat the debt as part of capital employed. That's why you could factor in. Treat the debt as part of capital employed. Now, adjustment to the balance sheet, it is non-capitalized lease. It's supposed to be capitalized. Why? Because it gives you capital, especially operating lease. If there is an operating lease, back in the days, we used not to capitalize it. You should capitalize if they tell you it's not capitalized, because lease will improve your business. And the one thing, we are looking at economic issues. And if it improves you or improve the business, then we add it. Research improves your business, so add it back if it was deducted previously. But goodwill written off, it improves, of course. It comes because your business has grown. So if it is written off because it was an expense, but generally it improved, it came because you created economic gains. That's why we have it. Excuse me. Provisions are, of course, because they are non-cash items, they're supposed to be added or adjusted concurrently. So unless there is any question on that, if there is no question, we have a demonstration to do. Hopefully time will allow us to do plus a past paper. If not, we'll do it, of course, in the next session, just as we still are We still are in this together. Question? Before we do the example now, there's an example. I could use open tuition. As I said, my consistency will be to maintain open tuition as my basis, but it is not in the lower level. It is in the advanced level. If you are checking open tuition, check the advanced performance strategies. Advanced performance, you will get it there. Is it? Question. No question? Okay, let's go here. That question I've already copy pasted somewhere here. I've already copy pasted there. So this is the question. Extract from the accounts of value company as follows. There is a 2014, 2013. I would want to use that. It is in the is in the open tuition. It is still in the 2023, so they keep on maintaining it. But the version I'm using is 2023. So there is revenue, there is profit accounting, pre-tax accounting, profit, which they say check note 1 for further issues, taxation, profit after tax, dividends, retained earnings. There's the balance sheet, which is given here, non-current asset, current assets, and then you have finance, which is shareholders' funds, and then mid and long-term loans, which is there. So after deduction of the economic depreciation of the company non-current asset, this also, the depreciation used for tax purposes, other information is as follows, meaning there is no difference, because they are saying the economic depreciation, if I understand that sentence, the two sentences properly, the economic depreciation was the same that was used also for the tax purposes, meaning it was the same as for that case. So other information is as follows. So we'll check and see if it's the same. Capital employed at the end of 2012 amounted to this. Now, there's a reason why they are giving you 2012. Some people ask why. Because it is called economic value added. They want you to compare 2013 from where you moved from 2012. So added has a meaning to that. Don't forget that idea. So we always compare from last year to where we are today, which is like 2023, I could compare with the 2022. For me to say is economic value added, I must have info of 2022. So there is in capital employed at the end of 2012 is equals to that. Number 2, value company had non-capitalized lease of 16 million in each of the years 2012 and 2014. The lease are not subject to amortization. So we could move. So that lease, we need to capitalize it in the balance sheet. Number 3, value company pre-tax cost of debt was estimated to be 9% in 2013 and 10% in 2014. We'll use this for Wachacha because we need Wachacha somewhere there as a minus. It is the minus part which is minused. And then value, but we need to convert to money, so we need percentages. Value company cost of equity was estimated to be 15% in 2013 and 17% in 2014. We need that, of course, to factor in Wachacha. The target capital structure is 70 and 30 for equity, 70% equity and 30% debt. We need this, of course, also for Wachacha. The rate of tax is 30% in both 2013 and 2014. So we need that probably for other issues, especially on the interest. Economic depreciation amounted to 64 million in 2013 and 72 million in 2014. These amounts were equal to the depreciation used for tax purposes and depreciation charge in the income statement, meaning there is zero adjustments will do. Because if they were equal, what is the need of adjustment? There's no need, because usually we add and subtract the one to, of course, offset and get the net off. Interest payable amounted to 6 million in 2013 and 8 million in 2014. Number 9, other non-cash expenses amounted to 20 million in 2013 and 15 million in 2014. Research and the development expenditure on a new project started in 2013. Research and expenditure on a new project started in 2013 and written off was 10 million in 2013 and 11 million in 2014. So we have that research and development. We need to adjust it expectively as it's expected because it means it was expensed. So we need to fix it back. And of course, as you say, research and development improves employees, economic benefits to the company. So calculate the economic value added. Let's go to the Excel here. I think I had tried to copy it somewhere here. The EVA issue here, I had brought it here. Let me see, it is this one here. So we have this, I think I had it here, so we could use it as explaining to what it is. So number one, or the first thing first, we are supposed to, I brought even the adjustments here so that you could check that and understand that what it is needed on that. There is the economic value added. I've brought even the summary here. I copy pasted all the summary, including these adjustments that we may need to make, like in this case here, and the adjustment in the balance sheet, which you may need also to make, which are also in this scenario here. And of course, that is what it is from that scenario. So that's what we have, and we can move ahead. Unless there's anybody with a question, let's check it out and move ahead. So the idea is to calculate what we have here. Now, because time is kind of moving, let me jump on it quickly as I could easily check other things later. So I want to start by adjusting the first element, which is the profits. We do adjust the profits and see how the profits will be from that angle. And then after that, we adjust, of course, I think you have already seen, and all of you are there. We're going to adjust also the balance sheet and see what the balance sheet will give us. And then from there, I think I'll also focus on now calculating Wachacha, because it needs you to calculate Wachacha. After you calculate Wachacha, then we check and see what it will give us from that area. So that's what you need to do. Now, first thing first, let's go to adjust the balance sheet, the income statement, sorry. Let's go to adjust the income statement for the 2 years. So we need to adjust the income statement for the 2 years, and then we'll understand what it is. So can go up here. So there is 20. We have, of course, 2014, which is there. So we have 2014, and we have, as they follow each other, we have 2013. So there is the related issues, which is, we'll start with the profit that we have, which is profit after tax. Profit after tax, profit after tax. Profit after tax is that one. So profit after tax is 88, and this one is 71. So do some adjustments. Do some adjustments, and those adjustments are the ones we need to do. Those adjustments are the ones we need to do. So the adjustments here are what we need to focus on. Now, one of the adjustments we need to do, if you check, you can come down here and check here. We have non-capitalized lease, no, it doesn't affect. Number 3, we have also this one here. Let me check, put it in a better zoom. We have, this is for the equities. This is Wachacha, Wachacha, Wachacha. All these are Wachacha. But we have economic depreciation, they say is similar, so we don't need to adjust that. But we have interest. So I'm checking the additionals, because the additionals gives you what it is. We have the interests, which we are supposed to adjust. So the interest here will add as what it is, will add only a portion of what we get there. So if you check, if I probably zoom it, we have in 2013, 13, they are saying it is 6 million. It is down here. And the other one is 8 million. So come here, do interest. Interest, but take interest, take interest after tax. Interest after tax issue, which will be 6 multiplied by 0.7. Tax was 30%, as you may check down there. So come here, take also 8 multiplied by 0.7%, and you get your figures there. Sorry, that is what we'll have. I think I could just delete this and move it closer here. So we have it that way. Then what else do we need to adjust? So we multiply by 0.7. 0.7 is after tax, 0.7 is after tax. What else do we need to adjust? Come down here, check. There is also non-cash expenses. One is this, which is said to be this one here. And the other one is said to be this, which is this one here, which is that one there. 15 and the 20, and we have the other figure which is related to that. So we have non-cash expenses. So non-cash expenses, we need to add them. As you have noticed, they are being given down here. We have said one is 20, or the way they have said, another one is 15. So take 20 and 15, adjust them there. I think we are together there. So next is we jump down here, come and check. There is research, but is the next item there? Oh, I jumped, oh, interest are fixed. So I fixed interest, which is there. I fixed also this. So I need to go to the next. Next I need to fix is development, research and development. Now, if you check, there is research and development that you may need to fix. Yes, please.
How these non-cash expenses are recorded?
How?
20 is for 13 and 15 is for 14.
20 is for 13. Oh, you're correct. So this should be 15 here, and this should be 20. Thank you. So that's the case.
Question, sir.
So yes, please. Thank you for that.
Which figures did we use to get interest after tax? Which figures did we?
We did it. We picked 6 multiplied by 1. Let's say the 6 multiplied by brackets 1 minus t. T is tax, so you take away tax, which is makes it 0.7, is it?
Yes, I can see that, but that.
And on the other side, it was 8 multiplied by 1, take away 0.3, which makes it 0.7.
Yes, that's 6 and 8. Where did we get it from?
They are down here. Let me give the note. There's a note. There's a note. Check note. Note, is it note 6? Let me give you. There's a note referred to as note 8. Note 8. Let me zoom it to say note 8 is 6 2013. I hope I did it correctly. Maybe I change. Oh, I think I did opposite. Let me start. My eyes is like 2013. I'm used to that. The first year starts here. So I think I did the opposite. This should come this side. And this one should come this side. 8. 8 is in 2014. 8 is in 2014. 8 is in 2014. So that could be like that. So meaning here is 6. And this one here is 8. Probably you have also opened my eyes. I had thought 2013 starts first and then 2014 follow. But I think it is now correct answer, correct put properly. This is this is that. Yeah, it's okay now. And then this is 15. I think it's okay. So we got it from here. Yes, 6 is for 2013, meaning it is here. Then
another question, sir.
Yes.
Why are we taking that interest, then we multiply it by 1 minus t? Why can't we take it? Is it an interest before tax, or why is it said?
You see, the idea is this: we took profit after tax. We took profit after tax. Let me do this way. Let me show you something here. You see, I can also take profit, pre-tax profit. Pre-tax profit is 134. 134. It is the idea it had passed through tax. Let me explain that again. But to show you the issue, let me do the opposite way or the other way. I could take this and I take this because this is pre-tax. Pre-tax profit. They will begin the same. So it depends with what you take. Now, this comes from the logic. I think those who are doing like managerial or something like that, you know very well when you are adjusting something called, there's something we usually adjust which is called interest benefit. If you have ever done managerial finance, there is something we call interest benefit tax relief. We always take it and multiply by 70% or after tax issue. Let me not be say 70 because it may depend with the question. Sometimes it could be different. So the same logic applies here. This is after tax. So this is after tax. It means it represents 0.7. Is it? Let's agree something. After tax represents point something of tax, meaning or point something of what the profit was, not of tax, point something of the original profit, because tax take away like 30%. So it means here there is 0.3 which has been or 0.3 which is taken out or covered out. So we are saying we are only adding 0.7 because this is out of 0.7. But let me show you what this comes to be a fact if you do here. If you deduct here the interest, I don't want to type so much. Let me just bring it here. Okay, let me type it, no problem. Interest. I could deduct here the interest before tax, which will be 6. No, this is 8, and the other one is 6, which will be that way. You will see they'll give the same. So here, because I started with this, and most of the examiner, they give this. This is after tax. So it means this is out of 0.7. 0.3 remained, or 0.3 has gone to tax. 0.3 has gone. They don't refuse the fact you should pay tax. Only part they refuse, you should not deduct it 100%. So 0.3, they accept that you should pay per taxes according to this. Taxes should be paid, which is why they are saying take only 0.7, which is supposed to be added back, because the 0.3 is already covered before you get after tax. Similarly, if you do this, it will be the same, and I'll show you what I mean by that. Here it is non-cash, and you will get that the non-cash here will pick, of course, as they are like that, and you move on like that. Anyway, let's first of all deal with that. So the idea is that it is 0.3, and that will be the case which will be factored in for the tax purpose. So 0.7 remains is after tax issue. I think you get that. There is that tax relief, which is also a part that you need to factor in. So 0.3 has already been covered. So I'm simply covering what is the 0.7 down. Why 0.3? Remember, interest is an allowable expense. What do we mean is an allowable expense? It means it is usually added back, and therefore 0.3 has gone out, so you should remain with 0.7. If you want to understand this, it is mostly also covered in managerial finance, because this is a tax relief we are dealing with, or strategic performances. That is the case. So anyway, just before, because I see time is kind of running, I want to show something before we kind of call it a day. There is research and development should come here. I'll call it R&D because of just, I need to move quickly. So R&D here, you come here, pick it from here. In 2013, they say it was 10 million. In 2014, they say it was 11 million. So let me hope I put here 11, and here they say it was 13, 10, sorry. In 20, that is 10 million. So that is what we have. So there's no any other adjustments because depreciation, they say it was similar. You get that is what you need to adjust and get this. Then you take this plus this, and you have your figure there. And you take the other one plus the other one, and you have your figure. And this is what is called adjusted profit based on economic terms. Adjusted profit. Now, assuming you are using also the other way, I think the deduction, let me see if they give the same. I think they usually give the same. Let me confirm. This is research and development, and you'll have your figures as this. Hopefully they give the same, but I've not tried it, but I think they should give the same because they have that. So this will be, you'll have this, and then you have that. I think I added too much of things here, including that. It is 168, It's not the same. There is an issue related to that. I think it's because these are added 11, this is 10. Yeah, it doesn't give the same, but sometimes it usually gives. But generally, the idea is that, let's see, if this is, you take 0.7, and then this one here, you take this what was deducted, which is what I'll find out later. But usually it's supposed to give the same. There's something, maybe I'll check it out. I'll find out what it is supposed to give the same in relation to that. Because here we added the 8, unless I've added wrongly, but it's supposed to give the same issue. But generally here it is because there's a tax issue which is deducted there, and you check what it is. Here we deduct 8 as a factor of that. Oh, I think I did wrong. I have noticed what my problem is. My problem is that I'm supposed to subtract, not add. I'm supposed to subtract, not add. I was thinking I did correctly. I'm supposed to do this, and then I do a summation of that, and then I subtract summation of all this. Something which I did, which was not correctly, but it gives 100. Not really the same as it is, but that's what it is. Because this, the total of these gives this, and the total of these gives that. I'll check. Usually it's supposed to give the same. Before we meet the next class, I'll find out why it is not relating to that. Because if you take this 100, this you'll get 100, which is that, and the rest is similar, which is 72 for that. Unless this one is supposed to be reduced by certain percentages, which is maybe why. But if you reduce by certain percentages, this is 0.7 of that. No, it doesn't work. Anyway, we'll check that later. I'll find out what cost it. But usually the idea is that there is tax issues which are supposed to be factored in, and those tax issues are supposed to be the ones that you consider, and you look into it. It's supposed to give that. I think if you take this minus this, does it give this? Yeah, it gives. So I'll check that later. Anyway, yeah, it should be the same. It should be the same. It's just something which I have not done. Somebody's saying it will be the same. It will be the same. It will be the same probably. It's just something which is not ringing in my head currently. But I've tried this. Always it gives the same if you factor in issue here. Because this one is before taxes. This one here is before taxes. So it means if they deduct probably, if they come here and try to get it 100, and they probably have a tax deducted or a tax added back for that case to be. I'll check that. I'll check that. It must be giving the same. I'll confirm later on in the next class. I'll have the answers why it is not the same. But generally, we start with profit after tax. Generally, we start with profit after tax. I'll check that later during my free time. For now, it is not ringing the bell, but I'll check that and find out why it was not giving out that. Anyway, so we get that. Now you need to adjust capital employed. Let me do that faster before we call it a day. I will check properly because currently I'm trying to do with the pressure of finishing this. I'll check when I'm seated down. It usually would give the same. In the next class, before we move on, I'll have found what caused the reason, or maybe it is not as it is, as I thought, but I'll confirm that later. So this is 2014. This is 20 that. Now we need 2012 to be included in this analysis for purpose of just checking what it is. and getting the value added. Eh? So capital employed, as you may start with that, the capital employed here is for 2014 is 400. How did I get 400? 400 is given in 2014 here. You will take from what we have, the capital employed for the year. Wait a minute, I think it's not 400. Let's calculate, let's see. This one is the starting. Eh? This one here is 300 and I saw 300. Yes, 350. So the capital employed here is 350, which is what we have. Now, this capital employed here is supposed to be the one that will open this year. It's the one that will adjust. Eh? So we'll take it as it is. So it opened the year. So this is capital employed at the opening of the period. Eh? Capital employed at the opening, not at the end, because I put they are at the opening period, opening. Let's call it opening. So it's capital employed at the opening. Yeah? So capital employed at the opening is equals to that, while this one is just closing. So I put it at the opening. I could delete it as such, but this one was on closing basis. But this one is opening because it came from 2012, it opens this year. Now, what is here will also come from what is down somewhere there, which is will be the one opening there. So let's do some adjustments. So some of the adjustments here, just before we call it a day, we have adjustments. The adjustment here, number one, is this one here. We need to capitalize lease. So non-capitalized lease. Non-capitalized lease. Non-capitalized lease is here. If you check, let me highlight it. It is this one here. Non-capitalized lease, they have said it is 16 million in each year. Is it 16 million? They have said it is 16 million in each year. So capitalize here, put here 16, and it's for 2012 to also 2014. So capitalize each year, sorry, not here, across the rows, columns. So add it here, it is 16 million, 16 million. Next is research and development. Research and development, R&D. R&D should be capitalized. How? Remember, research and development affects both sides. If you check here, it is here, because that is research and development. If you check here, it is also here. So add it. Add it as you may want to factor in. Research and development is, let's me read it properly again. Sorry, just a minute. Research and development is not 10. They say research and development on the new project in 2013, and the written off was 10 million in 2013 and in 11 million in 2014. So the research and development which was written off, it was written off in 2 years only, in 2013 and in 2014. So we'll only adjust it in 2014, which is 10, because this came from 2013, this research and development. If you check, it is coming from 2013. Remember, we are adjusting, this is a research R&D in 2013 being adjusted on this opening we'll have here later on, which will come from the summation of this. So then the next is non-cash expenses. As you check again, I take you back, what should be adjusted is things like provision. Provisions are usually non-cash expenses, so they should be adjusted. So non-cash, because a provision is something you are providing. You have not, it is not cash. So non-cash expenses, non-cash expense is that provision. Actually, let's call it just as it is there. There is a non-cash expenses. Let's see, where are they? Non-cash. Do we have provision really, or it is non-cash expense? Let me see. Just a minute. Yes, we have non-cash expense, which will turn to provision because it's not cash, meaning it has not been paid. So it is there. So non-cash expense is 20 million. And 20 million affects which year? Check again. 20 million affects which year? 20 million affects only 2013 and 2014. Now, 2013 will affect the year of 2014 as an added value. So you only adjust here and put here 20, which is again, as I'm saying in the comments, it is an adjustment of research and development, not research provision, or non-cash, which is a provision, non-cash, non-cash, which is usually comes to the provision expense that is from 2013. So you take 2013, you adjust here. And that is the case. So I've adjusted that. Here it is 0 because it is not coming from 2012. Remember, this one here is coming from 2012. This year, it is 2012 closing balance. 2012 closing balance that becomes opening balance. It's 2012 closing balance. So that's why they gave us that 2012 closing balance that is now 2013 opening balance with adjustment affecting it, with most of adjustments coming from where? From 2013, with adjustment relating to 2013, because adjustments means you are fixing something that was done on it. So you cannot fix something that was not done on it. Similarly, that is the same comment I'll put here. This is opening or closing. Closing, as it is opening here, it means it was closing from 2013. That is that adjustments are done. That adjustments are done relating to 2013. So don't adjust here something that is not there. Adjustments relating. English has disappeared a bit, or I'm just thinking too quickly. Relating to 2013 are to be adjusted there. So you pick them there and you have it there. So now that I'm done with this, I could easily add all that, and I get, this gives me that, which comes here. So my estimation was where it could be, and that opens up there. And similarly, you have this, and you run this through, and you get your figures. And that is adjusted capital employed. Adjusted capital employed. We'll calculate Kochacha on it later, but it's adjusted capital employed. So all the two are adjusted. The two factors are adjusted, as you may notice.
A question, Sam.
Yes, please.
How are these R&D different from one another?
From
With research and development, we are using it to adjust profit after tax, and this one we are using it to adjust capital employed. How are they different?
They are different. They are different. One is charge for the year. In the income statement, we charge for the year ended. In the balance sheet, we charge as at. That is number one. So it means this one that was charged in the income statement, this one here. This one was charged in the income statement, this one here. It is for the year ended, for the period of 12 months. The period of 12 months. Meaning it is connecting to that year. Like here it is connecting to 2014. Here it is connecting to this period. That's what you need to know. Now, if we check here, we have research and development issues. Let me check. Did I correct the correct figure? Research and development was 10, and here it is 10. Oh, it's okay. It's okay. It's okay. I was wondering if I picked I was taking 20. I was thinking I picked 20. It's okay. So research and development, here you are doing an adjustment as for the 12 months. Adjustment as for the 12 months. Here you are doing an adjustment for the previous year to be used today as the opening balance to be compared with what has transpired over the years. The idea is this. Again, let me explain something here. If I could draw a quick way, because this requires maybe even a physical drawing issue here, I could come here. Let's go to draw something. I could draw something here and show you. This is the case. The sharing, is it sharing? Resume share. Okay, this is the case here. Let me show you what I'm talking about. Here is the case. Just a minute. Here is the case. So if you check, this is what I'm saying. I could use maybe this color here. This is the case. There is the opening balance and there is what transpired over the year. So what transpired over the year comes usually from the income statement. Here, there is this capital employed, but you need to adjust. This capital employed that you need to adjust. Now, this capital employed, because you are assigned to find what did I get? Like, let's say this is 20, this is 20, let's say 12, you close the business. So there is this what you are gaining, which comes from here, from what you how you performed, which is supposed to be realized in the end of 2013. But our intention is not 2013. So we take this, we want to find, because this is our resource, this is our mitongo at that time. We want to see what has added to that, to us to be here. You see? So when I'm adjusting this, I adjust things which affected the previous period, which is 2012. Because I'm supposed to use this as where I will calculate my wachacha later on and find what is the cost of what I've invested, because you invest first to make profit, or you invest first to make operation, or you invest first to operate. So this is like our investment, or it is the investment to run 2013. So I'll calculate wachacha here. But there are some adjustments I'll do, which are advocating to economic terms, which I'm doing. That's why I adjust anything from 2012. After that, I adjust anything that the economic terms does not appreciate here from the additional, because it's the additional element, which will deal with it, and that's what I'm doing here. So here, this 10 is calculated because this 10 here is calculated because it's an adjustment of the year, is 12 months related. But this adjustment here is calculated, this adjustment here, if you check that adjustment that is there, is calculated because it affected 13. So I'm adjusting on 2014. Because if you go again, if you go to 20, just a minute, if you go to 20, just a minute for that. If you go to 20, let's say 14, if you go to 2014, the added value will mean you start from 13. You start from 2013. So the adjustment on this capital employed, the CE, will be done on what happened the previous period. So that's why I'm adjusting the 10 on this. And then there is the income statement that I need to adjust in 12 months structure, because income statement is for the year ended, balance sheet is as that. So I'm adjusting the 10 because, again, to answer your question, it affected the capital employed, because capital employed is made up of what? Capital employed is made up of equities. Now, those who are, you have done reporting, you know, equity, what it is, or rent asset movement. It is generally the capital plus shares plus retained earnings. So it means through retained earnings, it was removed. Through retained earnings, this 10 was removed. So I need to fix it back. And that's what I'm doing. And that's why I'm adding 10 here. And 10 came from here. It was adjusted on the retained earnings under the accounting way. So to fix it, I do the same way. I do that. And again, if you check also this expense is coming from 20, this non-cash expense, which is 20 million. It comes from 20 what? 13. It is what I'm also doing. All these elements here are coming from 2013. Even this non-capital is coming from 2013 because the opening here is from 2013 and the opening here is from 2012. I hope we understood each other. So you adjust the opening. You adjust the opening, not the closing. You adjust the opening. Are we together there? Before I close this chapter, because I need to close this, next time we'll do a past paper later on. But let me close this quickly. I think it's almost 9, and I think my intention is not to go beyond 9. So let me try to get that. I hope I've explained to you what I'm doing. So this came here. That is the difference. Why it is being adjusted here. This will be used in 2013. This will be used in 2012. So let me do the necessary issues. So we have that, which if you add, this will give you, plus that will give you that, which is we'll take here we'll take 400. I forgot. Here we're supposed, because you're adjusting, we'll take 400, not this one. Sorry for that. I'm supposed to take 400. 400. This is the closing which is given, not adjusted. It's supposed to be the one given. So you use given. I used wrong logic. It's supposed to be the one that is given. So this is a closing. Closing is the one that we adjust. I've seen the comments there. 2033 is adjusted relating to 20 that, which is this one here. I think you could see here. It's 400, no, not 366. 366 has already been adjusted. We take the unadjusted, we adjust. So these are what we have. So the capital we have here is referred to as opening, but also unadjusted. Unadjusted, if I may call it that in English. You know, English sometimes can be an issue. So anyway, let's calculate Wachacha. So to calculate Wachacha is easy. It will take only 2 minutes. 2013, what you do, you take just the averages, take 15%, multiply by 70%, take the other one, which is 9%, multiply by that. So I'll start with Wachacha for this. I'll start with Wachacha for this. So what you do, come here, take 15% is that one that I'm talking about, multiply by 70%. 15% multiply by 70% plus the other one is 9%. So take 9%. That's the cost of capital of that. Multiply by 1 minus 0.3. You remember those who do Wachacha, you take tax relief out and then multiply by 0.3, which will give you, if I multiplied, the percentages are involved here. So I have to multiply also this by percent here. I did not factor in the percentages, so it gives you that. Then 2014, I'll put the numerics later, but for purpose of interest of time, I need to do this quickly. So take the Wachacha here. Again, if you come here, take the 17 and 10. 17 and 10, I think the capital structure will be the same. So take 17, multiply by 0.7, plus 0.3, which is the structure issue, multiply by 10%, multiply by also 0.7, which is the after-tax case, and you have 14. I think it was 10%. Yeah, 10%. So you get that. Now, how do you calculate EVA? Let's calculate EVA quickly. So to calculate EVA, you take what you call adjusted net profit, which is that one here. We already have it, which is this one here. Take that and this. You get adjusted profit. And then you deduct the case here. So here you have also the capital employed, adjusted capital employed. So capital employed is adjusted is equals to this, and this one is equals to that. So do multiply it by Wachacha. Wachacha is this figure, and Wachacha is that figure. I'm just bringing them all together. Remember, this one should be sort of in percentage-wise. So it should be something like that. I think I put too much here. Let me put some zeros, percentages here, and then let me put percentages here to make it be 14. So once you do that, if you take this, you multiply with these, you get it gives you that. And if you take this, if you take this, you multiply with these, you get it gives you that. So take this figure here, subtract that, and you have your capital EVA, and this is our EVA. So we have our EVA value. The headline was EVA, the value is now EVA. We have this and that. If you take this, and subtract that, you get that. Take this, subtract that, and that is our figure. So unless there is any question, I will kind of stop here. It's already 9. I don't want to continue so much. I'll check this later on why it is relating to that. I think the issue is maybe relating to how I dealt with the taxes, but usually it's supposed to give a kind of similar issue. I think if you do it, you'll get 88. The taxes were that. So it should be able to give you 88 after you adjust that. But I'll check that later on. I'll check why it was that. So next time we'll do probably a practical question and then we'll see. Because I think I did not factor in taxes. Somebody is telling me that. I'll check that properly when I'm seated down and thinking properly on or thinking how it is supposed to be. But the idea is that if you do this and do the other way, they should give you the same answers. So let's stop here and we move on to the next class on next week. So unless there's any question, if there isn't, thank you for coming. I think I've explained that. Next time we'll do a past paper question where we'll deal with the scenario we have, right?
Thank you. Thank you.
Okay, thank you and welcome. See you next time.
Share with the Excel.
Okay, I'll share the Excel. Let me fix also this part and then I'll share it.
Thank you.
Okay, see. Namtumia, mwambie aende tu, no problem. Kwani hiyo ni sema wewe. Hizi ziko na namba yake. So
Why is it complicated?